Uh, Good morning, everybody. Welcome to our Wednesday webinar series on financial empowerment. Our speaker for today is Steph. Welcome, Steph, and thank you so much for spending time in, in empowering us financially and sharing all your knowledge with us. Steph is a business counselor with the PARO Center for Women's Enterprise, where she supports women in building financially stable businesses through strategic planning, confidence building, and practical financial literacy. She brings a diverse background that spans corporate law, nonprofit finance, and entrepreneurship. She has worked as an assistant finance manager for a multi-million dollar nonprofit and managed payroll and accounts payable for construction and service-based industries and businesses. She understands firsthand the challenges of cash flow, pricing, scaling, and financial confidence. Her approach is practical, empowering, and grounded in real-world experience, helping women move from overwhelm to clarity and control. Thank you, Steph, for joining us today.
Thanks for having me. So welcome. I'm glad that you have made some time today to kind of learn about financial best practices and compliance for small businesses. I'm not sure if it's your first series that you're hopping on, but this is series 3 of a 5-part series where we're kind of diving into different financial topics in each series. So today we're going to talk about financial systems because financial systems can be very intimidating, especially when you're juggling everything else in your business, but they're one of the most empowering parts of entrepreneurship once you understand them. So today's session is designed to take the mystery out of compliance and financial management. We're going to break things down into clear, practical steps you can actually use. Not theory, not jargon, but excuse me, real tools that help you run your business with confidence. So this is what's on the agenda for today. So quite a bit of information to go through today. We're going to start by Benita gave a really great introduction of me, which pretty much covers all of it. But we will talk about compliance for clarity, confidence, and decision-making. We'll move into CRA compliance. So the CRA, that's a very confusing part of entrepreneurship. So if I can kind of add some context to give you some generalized information, as always, I'm not an accountant. I have a background in finance, but it's always best that you speak with an accountant or the CRA for your specific business, because there's, different things for different businesses, as we'll get into in this workshop. So we will also walk through the 3 core financial statements every business owner should understand. We'll talk about budgeting and cash management, including a simple framework you can adapt to your business. And we will wrap it up with record keeping and audit proofing because good systems protect you. Throughout the session, you'll have opportunities to build your own tools, ask questions, and apply what you're learning. So if at any point you have a question for me, just I think there's a raise hand option, or just just jump right in and interrupt me if you need to. So just to add on a little bit about myself, I'm a business counselor with PARO, background in finance. I have a deep experience in business startups. I've helped entrepreneurs navigate everything from registrations and structuring to the nitty-gritty admin work that gets a business off the ground. And before joining PARO, I worked as a corporate law clerk in the past. So I've spent years advising on business structures like corporations, sole proprietorships, and LLPs. And not legal advice, just generalized information. And I know how important it is to get those decisions right from the start. Outside of work, I'm a single mom of 2 boys, and I bring that lived experience into everything that I do. I understand the balancing act, the drive to build something meaningful while managing life's responsibilities. I also love interior design and find conversations around personal growth really energizing. The kind that like sparks new ideas and helps us grow as people and professionals. Okay, so, oh, yes, okay, so financial best practices and compliance. When we talk about financial best practices, we're really talking about building a foundation that supports your business as it grows. So strong financial systems do three things. They keep you compliant with the CRA, which means fewer surprises, fewer penalties, and less stress. They give you clarity, so you can make informed decisions instead of guessing. And they make you funding ready. Lenders and grant programs want to see organized, accurate financials. So having these practices in place just really takes a lot of the overwhelm. You know, if you start from the beginning, it's not something you need to do to catch up. It's just something you already have in place, and then you're funding ready, you're CRA compliant ready, your audit ready if need be. So think of this as building the infrastructure of your business, the systems that keep everything running. So let's talk about HST registrations. Is anyone overly familiar with the process of registering for HST with the CRA? Okay. So it is one of the most commonly misunderstood areas for small business owners. And honestly, it's not their fault. Even when I went to, my bookkeeper, my tax preparer in the past, and, kind of want just generalized information on when to register and what triggers like the requirement to register. It's a very generalized, you don't register until you've reached 30,000 in gross revenue. That's a very vague answer. So there's some nuance behind it, and I hope to offer clarity so that there's not, any surprises in the future for when you are looking to register and what the requirements for meeting that 30,000 threshold are. So the CRA uses a rolling 12-month period. So for example, it's not just January to December. Let's say in April of 2025, you had 5,000 in gross revenue sales. In September, you had another 10,000 in gross revenue sales of September 2025. And then in February of 2026, you had another 15,000 in gross revenue. So that's still a 12-month period, although it's not, January to December, or it's not your fiscal year. As soon as you hit 30,000 in that 12-month rolling period, that triggers you to get your HST number if you haven't gotten one already, and start charging tax on your services and your products. So once you hit that 30,000 threshold, you will always, from that point on, charge taxes. Up until that 30,000 threshold, you do not need to charge taxes on your services, your products. So let's see here, make sure I got everything. Yeah, once you register, you stayed registered and continue charging HST unless you formally close the account, which would require you to like call into the CRA and let them know that you want to close your HST account. Otherwise, it remains open. You have to report on it every year in your taxes. So there's like no reset. Whereas, if you think about your calendar year or your fiscal year, that resets. This is a little bit different than that. And I think that that's where the confusion kind of comes in with how does the HST threshold really work, and when do I start charging, and is there a reset like with your taxes, and there's not. So if I didn't explain that very well, just let me know and I can kind of try to re-explain it. But yeah, I hope that kind of very simply answers the question on the 30,000 threshold for registering for HST. Now, there are a few situations where early registration can actually be beneficial. So if you have significant startup costs or equipment costs, registering early lets you claim back the HST you're paying on those expenses. If your clients are other businesses, they can claim the HST anyway, so charging it doesn't impact them. And if you prefer to set up your systems from day one, registering early can just simplify your processes instead of switching mid-year. And then I guess really, if you want to just appear to be more established, charging HST can signal that you're operating a more advanced stage of business. But this is the part I always emphasize. Every business is different. And as I'm not a tax professional, I always encourage clients to check with their accountant or call the CRA, like I was saying before, just to confirm that, you're setting your systems up in a way that benefits your specific business. Yeah, it's not like a one size fits all kind of situation. Okay, so payroll. Payroll is one of those areas where people don't realize what they're taking on until they're already in it. So if you hire employees, even if it's just one employee, you're responsible for deducting income tax, CPP, and EI from their pay. You are responsible for remitting those deductions to the CRA and paying the employer portion of CPP and EI. You're also responsible for issuing T4s at year end and keeping accurate payroll records. And this part kind of trips people up. Even if you think you're hiring a contractor, the CRA may classify them as an employee based on the nature of the relationship, not the title that you give it. So CRA looks at things like who controls the work, who provides the tools, whether the worker can profit or take on other clients, how integrated they are into your business. So if the CRA decides someone is actually an employee, you may be responsible for backdated CPP, EI, penalties, and interest. So it's really important to classify people correctly from the start. Talk to your accountant again or the CRA if you have any questions about that, just to make sure that you're compliant and there's no surprises in the future. Any questions on payroll?
Steph,
Yeah.
suppose I'm running my own business and I want to add myself as an employee. So would the taxes be more for me as an employee in the business or as the business owner?
It depends on how you're structured. So would you be a
If
sole proprietor or incorporated?
an incorporation.
Okay, so when you set yourself up as an employee of the incorporation, you're setting yourself up just like every other employee. Just the difference is that you don't pay into EI. You can still pay into CPP, but you're not eligible for EI, so therefore you don't pay into it. And
Okay.
sorry, am I missing part of your question, Benita?
Uh, no. That was what I was asking about. I mean, would the taxes be same as a business owner and as an employee?
Yes, for you,
Okay.
I mean, aside from taking not deducting your EI, everything else would kind of be the same. It's kind of a little bit easier in that sense because when you use a program like QuickBooks or any other payroll program, you're going to be set up and you're going to have your taxes deducted and it's just going to kind of happen just like getting paid from any other
Yeah.
employer.
Okay.
Yeah, so it's kind of just the exact same as being an employee. And the
Okay.
other thing to note as a business owner is when it comes to WSIB, depending on what your business is, there's also some, things about that where they won't cover you as a business owner. They'll cover your other employees, but not you as a business owner. But I think it also depends on exactly what line of work you're doing.
No. Okay. Yeah. Thank you so much, Steph.
Yeah, no problem. Um, Okay, and then income tax. So there's business versus personal. This is another area where structure matters for sole proprietors. Your business income is reported on your personal tax return using the T2125 form. Your business isn't a separate legal entity. So where I was kind of explaining to Bonita, if you're incorporated, you are an employee of the corporation. But when you're a sole proprietor, the business is you. So the way that you pay yourself is structured very differently when you're a sole proprietorship as it would be in an incorporation. You can set yourself up, like I was explaining, as an employee of the corporation, but when you're a sole proprietor, you're looking at owner's draws. And then you're also responsible for putting taxes aside on your own to make sure that you have the taxes, what that you need to pay when you file your personal tax return. Um, so your business, yeah, when you're a sole proprietor, business is in a separate legal entity. You pay tax based on your total personal income. So that's for sole proprietors. For corporations, the business files its own corporate tax return. You may also pay yourself through salary or dividends. I guess that's a whole other kind of, salary is one thing. It's set up, most like an employee, but when you get into dividends, you're talking about share structures, and that's a little bit more, yeah, that's a little more legal heavy, I guess I could call it. You'd want to work with your lawyer on your dividend structure and everything like that. So the business is a separate legal entity from you as a person when it's a corporation. And then regardless of the structure, you must report business income even if you didn't make a profit. You can deduct reasonable business expenses. Keeping business and personal finances separate makes everything easier, as usual. And good bookkeeping prevents missed deductions and red flags. The CRA doesn't expect perfection, but they do expect consistency, documentation, and reasonable claims. So compliance becomes much easier when you understand the basics and set things up early. And my role isn't to necessarily give tax advice, it's just to help you understand the landscape so you can make informed decisions and know when to bring in the right professionals. Okay, so any more questions on that before I dive into this slide? So bookkeeping systems, there's no, again, right or wrong answer on how you go about doing this. It's really just dependent on what your business is and how much activity is involved in your everyday business. Maybe if you are running a little on the side photography business, you don't have a need for, paying for bookkeeping software and things like that. Maybe you can get away with working on an office spreadsheet. But when you're, maybe you have a spa where you have, clients coming in all the time and products that you're purchasing and things like that, that's a situation where it might make more sense to have bookkeeping software. Just because the sheer volume of the amount of information you're inputting is just a lot more, and it'll be easier to organize. So this is one of the biggest operational decisions you'll need to make early on, and it has a huge impact on how easy or stressful your year end becomes. So most entrepreneurs start with spreadsheets, and honestly, there's nothing wrong with that. In the very beginning, spreadsheets can work well when you're small, your transactions are simple, and you're still figuring out your systems. But there's a point where a spreadsheet stops being efficient and starts becoming risky. So let's break down the difference. So spreadsheets can be a good fit when you're just starting out. You have very few transactions, your business model is simple, you're comfortable with manual tracking, but spreadsheets rely entirely on you. Your accuracy, your formulas, and your consistency. There's no automation, no built-in error checking, and no audit trail. As your business grows, the risk of mistakes grows with it. So common issues I see with spreadsheets are missed expenses, duplicated entries, broken formulas, no real-time financial picture, and harder for accountants to work with. And then you spend more time manually updating it. So they're a great starting point, but maybe not a great long-term system. Whereas accounting software is designed to make your life easier as your business grows. It automates the things that spreadsheets make you do manually. The benefits of accounting software are it automatically imports bank and credit card transactions. It categorizes expenses for you. It generates invoices and tracks who has paid their invoices. It can calculate HST for you. It can produce financial reports instantly. It makes your year end dramatically easier. It reduces errors and missed deductions. And it gives you a real-time picture of your business health. So your accountant will spend less time fixing things, which means you spend less money at year end. Software isn't just about convenience, it's about accuracy, efficiency, and having the information you need to make decisions. So a good rule of thumb for when to switch from spreadsheets to software is if you're spending more than an hour a week on bookkeeping, if you're starting to feel behind, it's time to switch. Other signs you're ready for software are that you're charging HST, you're invoicing regularly, you have multiple revenue streams, you're preparing for growth, or you want cleaner financials for funding or lending. So software becomes a business asset, not an expense. Any questions on accounting software versus spreadsheets? Okay. Okay, chart of accounts and bookkeeping workflows. When we talk about bookkeeping, we're really talking about the systems that keep your business financially healthy. Most entrepreneurs start with spreadsheets, and that's totally fine in the early stages. But as your business grows, the system you choose and the workflows you build around it make a huge difference in how organized, confident, and prepared you feel. So, your chart of accounts is simply the master list of categories your business uses to track money in and out. It's the backbone of your bookkeeping system. It includes things like your revenue categories, your cost of goods sold, your operating expenses, your assets, such as equipment or inventory, your liabilities, that's like loans or credit cards that you have, your equity. It matters because it keeps your bookkeeping consistent. It makes your reports meaningful. It helps you understand where your money is going. And it makes tax time easier. It supports better decision making. And it's built in the software, but in spreadsheets, you have to create it on your own, which is where things often get messy. And that's, formulas aren't working. And then frustration grows. And you probably just get to a point where you're saying, oh, I should have just went with the software. Workflows are the routines that keep your books clean all year. So there's different ways of like structuring your workflow. You can do a weekly workflow, which would be like uploading your receipts, categorizing transactions, sending invoices, recording payments, and following up on overdue invoices. Your monthly workflow could include reconciling bank accounts and credit cards, reviewing income and expenses, checking for duplicates or missing entries, and setting aside money for taxes, and reviewing your profit and loss. And then there's quarterly workflow, which would include reviewing your profitability, checking your HST collected versus paid, and assessing expenses and pricing and planning for upcoming seasons. And then your year-end workflow would include things like ensuring everything is reconciled, your receipts are organized, you review your chart of accounts, and prepare reports for your accountant. So good workflows reduce stress, prevent mistakes, and make tax time smooth. Any questions on chart of accounts and workflows? So understanding financial statements. So I want to show you how all of everything that we've already talked about translates into the financial reports that you'll use to actually understand your business. These reports aren't just for accountants, they're tools that help you make decisions with confidence. When your bookkeeping is clean and consistent, these reports become incredibly powerful. So there's an income statement that includes your profit and loss. This is the report most entrepreneurs look at first. It shows your revenue, your expenses, and your net income over a specific period. So a good profit and loss helps you see which services or products are performing. It helps you with to determine whether your pricing is sustainable and where your money is going. It also helps you ensure that other expenses are aligned with your goals and how profitable you actually are. So this is where your chart of accounts really matters because it's kind of breaking each category down so you can actually see, what parts of your businesses are performing better than others. And then it helps you, shift gears if you need to. Maybe one service isn't making you as much money as you thought. So maybe you remove it to replace it with another service. This just gives you kind of like the financial picture of how well your business is doing. And you're having your chart of accounts breaking things down, kind of like lets you see exactly what's performing best. So because the categories you set up determine how clear and useful your chart of accounts is, that's what makes it so valuable. There's also the balance sheet. So this is the report everybody kind of prefers to ignore, but it's just as important. It shows what your business owns, what it owes, and what's left over. So it includes your assets, that's cash, equipment, and inventory. It also includes your liabilities, such as loans, credit cards, or taxes owed, and your equities. So that's retained earnings, owner's draws. So this report helps you understand the health of your business, not just your income. And it's also what lenders and funders look at when assessing stability. Then there's the cash flow overview. So this is a profit and cash flow. Sorry, profit and cash flow are not the same thing. You can be profitable on paper and still struggle with cash. So does anyone know what the difference between recording under cash or accrual is? Okay, so cash would be, when an invoice is paid and the money is in your account. When you would choose to you can set up your bookkeeping software so that it can be recorded as cash or accrual. So cash would be like invoices paid, money in the bank account. Accrual would be invoices sent out, money is expected to be received, but not actually in the bank account yet. So there's benefits to setting it up one way or the other, and you can always change it in your bookkeeping software at any point in time. But that's really the difference between cash and accrual is just one, cash means that invoices is paid and money is in the bank account, and accrual means invoices are sent out, not paid yet. Does that make sense? Yeah. Okay. So a simple cash flow review helps you see what's coming in, what's going out, what's left over, whether you can cover upcoming expenses, and whether you might need to adjust spending or timing. So this is where your weekly and monthly workflows pay off because you're not guessing. So as long as you're kind of inputting data, like whether you're buying, stuff and you're inputting the receipts, and then you're matching the transactions with your bank account set up. I'm having a hard time explaining this. But so in a bookkeeping software, like your bank account transactions will all be shown. And then when you're inputting a receipt, it will want to match the two. So you're reconciling your accounts that way. So it's just like really good to stay on top of reconciling by inputting the receipts and then matching it to the bank transactions. So when your reports are accurate and up to date, you can make informed decisions instead of reacting or guessing. You can answer questions like, can I afford to hire somebody? Should I raise my prices? Is this offer actually profitable? Can I take on this new expense? Am I paying myself sustainably? Your reports become a dashboard for your business. So your chart of accounts is the backbone of your reporting. It ensures that revenue is separated by stream, expenses are categorized consistently, You can see trends over time. Your reports are meaningful and easy to interpret. Your accountant can file quickly and accurately. So a messy chart of accounts leads to messier reports, and a clean one gives you clarity. Any more questions on that? Okay. So why budgeting matters. So a budget gives you a clear picture of what it costs to run your business, how much revenue you need to cover those costs, when you can afford to invest, hire, or scale up, how to prepare for slow seasons, how to pay yourself sustainably. Budgeting helps you make decisions based on facts, not feelings. It also reduces stress because you're not constantly wondering whether you can afford something you already know. A good budget is realistic, flexible, and updated regularly as your business evolves. So fixed costs are like your non-negotiables. These are expenses that stay the same month after month, regardless of how much you sell. These are your baseline costs of keeping your business open. So examples include rent or workspace fees, insurance, software subscriptions, phone and internet, bank fees, loan payments, accounting or professional services. Fixed costs matter because they tell you the minimum amount your business needs to earn just to exist. This is the foundation of your break-even point. Variable costs are the costs that move with your sales. Variable costs change depending on how much you sell or produce. These are the costs tied directly to delivering your product or service. Examples include materials and supplies, packaging and shipping, contractor labor tied to client work, payment processing fees, travel for client projects, inventory purchases. Understanding your variable costs helps you price your services properly. It helps you protect your profit margins and avoid undercharging. And they also help you to see which offers are actually profitable. This is where your chart of accounts and workflows help because consistent categorization makes these patterns easy to see. Building a simple, effective budget would include having your fixed monthly costs included, your average variable costs, your revenue targets, your tax that is set aside, and your owner pay, a buffer for unexpected expenses. You don't need anything complicated. Even a simply monthly plan gives you clarity and control. Your budget should answer, what does it cost to run my business each month? How much revenue do I need to cover that? How much can I pay myself? What can I afford to invest in? And what needs to change if revenue slips or dips? How budgeting supports decision making. So when you have a budget, you can confidently decide whether you can take on new expenses, whether you need to raise prices, whether you can afford to hire help, whether a new offer is financially viable, and how much to set aside for taxes. So budgeting turns uncertainty into strategy. How this connects to everything else, it's clean bookkeeping, it's a clear chart of accounts, it's a consistent workflow, and it's accurate financial reports. All of these pieces working together ensure that when your numbers are accurate, your budget becomes a powerful planning tool instead of a guess. Has anyone heard of the 50-30-20 rule before? I think it's honestly something that is used in personal finances, but it can be adapted for businesses as well.
So it's normally used by independent contractors, I guess, or yeah.
Yep, for sure. Excuse me. I would see this more with sole proprietors, not so much corporations. But it's just a way of structuring the money that's coming in, the revenue, and ensuring that, money's put aside for growth, for taxes, to pay yourself, and to continue to operate. So there's no like this isn't like a set in stone 50% must be for operating costs. You can kind of tweak it to align with what your needs are for your sole proprietorship. But the 50/30/20 rule is just a simple way to think about how your revenue gets allocated. It gives you a starting point for planning, for paying yourself, and for staying on top of taxes without feeling overwhelmed. It's not a strict formula, it's a framework. You can adjust based on your business model, your industry, and your goals. So 50% often is used for operating expenses. So it's the money that it takes to run your business day to day. It includes your fixed costs and your variable costs. It includes things like rent, software, subscriptions, insurance, supplies and materials, any contractors that's tied to client work, marketing, equipment, and payment processing fees. So keeping operating expenses around 50% helps ensure your business stays sustainable and profitable as you grow. 30% for owner's draws. So this is your compensation, the amount you pay yourself for the work you do in the business. Many entrepreneurs underpay themselves without realizing it. So building owner's pay into your budget is essential. This category helps you pay yourself consistently, separate business and personal finances, understand whether your pricing supports your income goals, and avoid relying on leftover cash at the end of the month. And then the 20% for taxes and savings, it's the money you set aside for future investments and financial stability. And it's probably one of the most important habits you can build. So that would include, of course, your income tax, HST you've collected, if applicable, emergency funds, future equipment or upgrades, and then slow season buffers. So kind of always planning in advance, having some money put aside so that, you know, when the season slows down, you're not kind of scrambling for how to continue to stay afloat. So setting this aside regularly prevents stress at tax time and gives your business breathing room. The 50/30/20 rule helps you understand whether your business model is financially healthy. It helps to see if your expenses are too high. It checks whether your pricing supports your income goals. Of course, it's building consistency in your financial habits, and it's avoiding surprises at tax time and creating stability and predictability. It turns your revenue into a plan instead of a guessing game. So like I said, every business is different. Some industries have higher operating costs. Some service-based businesses have lower overhead and can pay themselves more. Some entrepreneurs need a larger tax set aside depending on their income level. So the goal isn't to force your business into these exact percentages. It's to give you a framework you can adapt. What matters most is that you're intentional about where your money goes. Any questions on the 50/30/20 rule? So record keeping and audit proofing. So I put, if the CRA asks for proof tomorrow, could you produce it? And the answer is you always want it to be yes. You want to be, you know, ready for anything that the CRA comes and says, we require this from you. We need to see proof of this. You know, you definitely don't want to be scrambling in that situation. So starting out from the get-go with, you know, excellent financial record keeping is one of the best things you can do for your success. So the goal isn't to be perfect, it's to be consistent, organized, and able to show how you run your business. Good bookkeeping is the foundation of that. So audit proofing isn't about avoiding the CRA, it's about being prepared. It means your records are clear, consistent, and easy to understand. So if the CRA ever asks questions, you can confidently provide what they need. So audit proofing is built on clean bookkeeping, organized documents, consistent workflows, a clear chart of accounts, and separating business and personal finances. When these pieces are in place, then audit becomes a process, not a crisis. So it keeps the business and personal finances separate. This is one of the biggest red flags the CRA looks for. You can audit proof your business by using a dedicated business bank account and using separate credit card for business expenses and paying yourself through owner's pays instead of mixing funds. It gets a little bit, like I was explaining earlier, it's a little bit easier when it's an incorporation and you're kind of set up as an employee, but when you're looking at the owner's draws, that's where the 50, as a sole proprietor, sorry, that's where that 50-30-20 rule really comes in handy. So it's not like you're at the end of every month like, oh, this is what all I can afford to pay myself. You've worked it into the entire structure of how your business is going to operate and succeed. So yeah, so paying yourself through owner's pay instead of mixing funds. So separation creates clarity and protects you. Keep every receipt. Digital or paper copies are fine. QuickBooks actually has an option where you can scan the receipt and upload it and attach it to the the transaction and everything. So yeah, if QuickBooks is one of the best bookkeeping tools that there is out there. But there's a lot of other ones like QuickBooks. I think QuickBooks is probably just the most like broadly used. So yeah, keep every receipt. The CRA requires proof of expenses, not just bank statements. So audit proof habits include keeping digital copies of receipts, snapping photos immediately, storing them in one consistent place. So you can use like a cloud-based service like Dropbox or something, and you can even, take a picture on your phone, upload it to a file in Dropbox, and then you're able to kind of access Dropbox from your phone or your computer. And it's just really easy to grab those receipts. Storing them, yeah, in one consistent place and making sure receipts show vendor, date, amount, and purpose. So sometimes, it happens where you forgot to get a receipt or you lost the receipt. As long as it's not a habit and it's not like you have a crazy amount of handwritten receipts, the CRA will, they'll allow like a little handwritten, I don't know, maybe you picked up bagels or donuts or something for the office, let's just say. You just make a little receipt, you put what it was for, it was for the staff. And that's okay as long as it's not, a habit. And for the most part, like if it was something a bigger purchase, you can always go back to the store. They can reprint receipts if you can kind of provide them with the time that you were there. So if you're ever missing like a really important receipt or invoice for that matter, you can always try and reach back out to the supplier or vendor. Software makes this easier, but even a simple folder system works if you're consistent. So document the why behind expenses. The CRA wants to understand the business purpose of an expense. You can audit proof by adding short notes to the receipt, like client meeting or materials for workshop. Keeping mileage logs. That is one that the CRA, if you have vehicle use, they are quite strict about that. So keeping a mileage log is actually really important. And there is apps for that as well. I've used one in the past. I can't recall the name of it, but I was able to differentiate between personal and business use and then record the mileage. Like it came with a little thing that went in my car, and anytime I was driving somewhere, it recorded the mileage. And then I just had to go through the list and say, okay, that was for business use, that was for personal use. So a lot of really great apps and tools like that to help you with recording your mileage. You want to also track client related travel and then save invoices and contracts, of course. So, just getting in the habit of writing on your receipts what it was for so that at the end of the month or, if you have fallen behind and you're trying to go through all your receipts and enter them, you're not kind of wondering like, well, what was that? What was that for? And especially when you start having employees working for you and they're, maybe they're running to get supplies or maybe you ask them to pick up, coffee for the office, you don't always know exactly or remember what that was being used for. So, or what that purchase was for. So just making sure you put a quick note is just the easiest way to not fall behind in that sense. So reconciling is one of the excuse me, strongest audit proofing habits. Your monthly reconciliation helps you catch errors early, ensure that nothing is oh my goodness, missing, confirm your books, match your bank, and keep your reports accurate. This is where your workflow really matters. And again, consistency. That's probably like one of the biggest words to remember in business in general, whether it's finances or whether it's just, the success of the business is consistency. That is going to be the make it or break it for you. Is just how consistent you are with staying on top of things, being disciplined, even when things might seem like doomy and gloomy in your business, just staying consistent with, what the goal is, and not giving up on your dreams. So consistency is probably like, you could pick one word, that's the one. And use your chart of accounts consistently, of course. So your chart of accounts is your audit proofing backbone. It shows the CRA you have a clear system, you make your reports easy to understand, and it prevents misclassified expenses and reduces your end cleanup. Let's see here. Okay, so I think that pretty much covers. Okay, so I think that that's all of the information, which I felt like that was a lot of information, but I hope that I explained it in ways and that are kind of easy to understand. And I think I was redundant a lot in what I said, but like maybe it really drilled it in. Because I know this isn't the most exciting information to learn, but it's very important information. So does anyone have any questions at all about anything that I covered in this series? Okay.
Okay.
Bonita, do we have
Yeah.
a survey for them to do?
Uh, yes, I will just put the survey link in the chat
Yeah.
box and you all can fill in the survey. And yeah, so thank you so much, Stephanie, for spending your valuable time with us. We've learned a lot during the session, and there were a few things that we were confused about, but you've been so clear. Thank you so much for sharing your knowledge with us. And thank you, everybody else, for joining the session today. We have two more parts for this session on financial empowerment, which will be later on. And we will email you the links and the details of those sessions later. So thank you so much and hope you have a great day.
And I guess just one more thing to add is if there's the other series like series 1 and 2 that you're interested, I think you can also email is it Lori, and they
Yeah.
can get the recordings for
Yes.
those.
You can either email me or Lori to get the recordings for those. I'll add in our emails too in the chat. So this is my email and Lori's email is
Yeah.
yeah.
So
Yeah, you can email either one of us and we will share the recordings with you for the previous sessions. Yeah, okay.
and just a note that the first series was on personal finances and entrepreneurial readiness, and the second series was business structuring and financial setup. And then, of course, today was financial best practices and compliance.